Hello, bankers. Welcome to Learning Sessions. I'm Himanshi Malik, and today we are going to discuss Module C of AFM. So, Module C is going to be about financial management, and in this video, we are going to cover the complete chapter 19, that is the first chapter in Module C. So, this is going to be a very important lecture for you because it will cover all the important aspect that you need to understand, the basic concept that you need to understand before we delve into the advanced topic of financial management that are further in this module. So, one request to all of you, do watch the video till end so that you will be able to cover all the concepts in detail. And if you want to prepare for your JIB exam, do enroll in the early bird pack, and you can do so by downloading the Learning Session IIBF exam app, which is available on Android and iOS both. So with this app, you will be able to enroll in the course and get access to all the quality educational content that we have prepared for you. So this is about 19C chapter. So let's get started. Financial management and overview. So first of all, what is financial management? As banker, we are mainly dealing with finances, right? We are dealing with savings of people, we are dealing with their loans and investments, savings, and these particular services we are providing to all sort of customer. So first of all, in financial management, we need to understand what our customers needs are. So one thing we all know, that everybody who is dealing in banking, either it is a business or it is a salaried employee, they are willing on doing one thing. They want to be good in their finances, right? They want to improve their financial condition, they want to grow financially. That is the ultimate purpose of every business. So what we are going to do in this chapter, we are going to understand the mindset of our customer, our clients, that what financial management they need to do, because as banker we can only provide them good services when we know what their needs are. So this chapter is going to help you to understand who your customers are, who are the people you're going to deal with, and what are their needs and problems. Once we are clear on that, then we will be able to understand how as banker we can improve their life. Okay, so this is how you need to study every chapter or every module in your course, because this is a mindset that you should have. Okay, what are the needs of person I am serving? Only then you will be able to do good service to them. So that's on the part of business and professional. Let's focus on the exam point and start with this chapter. So first of all, we need to understand what is financial management, because this whole module is going to be about that. So it is applying the management principle to matters related to financial resources and activity of the organization. That we need to understand how we are going to manage the financial resources, how we are going to manage the capital, the debt, sales, purchase, everything, working capital. All those things are covered under financial management. So this chapter is based on the building blocks of modern finance, which divides that modern financial management or finance function in corporates is divided into four parts, where first of all, any financial management need to involve in the planning part of the process. So in planning part, we need to understand what are the plans for the year, what is my revenue looking like, what are the capital needs, what will be the working capital requirement. We plan all those things, we forecast these things, and then we see what our needs and requirements are. The first step is planning. Then once we are clear on what is needed in the upcoming period, let's say I am doing the financial planning for a year. So I have sorted that, okay, my revenue will touch up 2 million this year, and for that, I am going to need working capital of at least 500,000 available with me per day. On daily basis, at least this is needed, right? So this is what I've decided. Now, decision making comes that this is our requirement. What can we do to fulfill this requirement? What actions do we need to take? What working capital facility do we need? What loans we need? Can Are we able to expand our operations right now? If we're going to expand, how am I going to finance those things? Now everything, every aspect of business is related to finance. So all those decisions are taken once we have done the planning. So the first part is planning. We picture what the upcoming period looks like, and then we take decision to make those things happen. Then third thing, once we have arranged the resources, I have arranged the capital, the debt, whatever was needed. Now the next thing that we need to do is organize the funds in a particular way. And how do the financial managers organize the funds? So this is where the part of budgeting, right, budgeting and controls come. So we know that in budgeting, what do? We allocate, okay, for this particular month, this is the salaries that we are going to afford, this is what we can afford on interest, this is what we need on raw material, whatever the industry is, this is how they set budgets and organize their financial resources. Once that is done, the next part is to control, making sure that whatever was decided, that remains within the planned part only. Because what planning is of no use if I'm going to do anything anyways. For example, if I decided that on a particular month, let's say July 2025, I am going to produce 100,000 units because that is what we can afford only. So it is important that my production department understands this budget, understands this requirement, and stays within it only. Because if they surpassed this limit or they did not make to this limit, then what is going to happen? My financial planning will disrupt and the company's position will impact greatly. Because understand one thing, all the departments, all the parts in the financial management of a company are interlinked to each other, so we need to make sure that everything goes according to the plan. So that these are the four building blocks of any financial management in any organization. First we plan, then we decide how we're going to follow our plan, execute our plan. Then, once we have taken decision to execute the plan, it is important we organize it the right way, and everything was going. We need to check that everything is going on as per the plan, and that is called controlling. So, building block of modern finance is done. The next part is that you need to understand in the beginning of financial management, what kind of financial organizations are there, what kind of business organizations are there, because each big business organization is going to have a different legal structure, different kind of management, different kind of needs, scale, and according to that their financial management strategy will also differ. So the first foundation that we need to build in understanding financial management is to understand the type of business organization. So let's start with the first very basic type of business organization, that is called sole proprietary firm. All of us are familiar with this type of system, we have seen it in our daily life. For example, where the grocery shop around the corner of your street, that's a sole proprietor business, right? It is a firm or business that is owned and run by one person only, and there is no legal difference between the owner and the firm, right? So that is your sole proprietary firm, that is the basic and first type of business organization. So let's understand the basic features of sole proprietary. First of all, any sole proprietorship business is going to have no distinction in the assets and profits of business and owner. All the assets of business are owner's asset and all the profits are owner's profit, because there is no other person involved. There's only one person, so everything is related to him only. Number two, sole proprietorship is the simplest form of running an organization. You do not have much legal requirement except some of the sales tax requirement, but you do not have any business structure requirement like partnership act or corporate act. These things are not applicable on you, so you have minimum regulation. Then One of the downsides of such kind of businesses, since it is run and operated by one person only, so the business is going to grow as much as the owner can bring in the capital, and that's it. If the owner can afford only, let's say, up to 10 crore of capital, the business is growing up till that only, because he cannot bring the capital from other people, because it is the sole proprietorship firm. So they do face limitation of capital resources. This is the first type of business organization that we are all aware of, sole proprietorship. Next, we have partnership firm. So in sole proprietorship, we had only one person running the business, one person owner. When we add another person in this, it becomes a partnership, right? So partnership is a business that is carried on the basis of relations between persons, and these people have agreed to do what? They have agreed to share the profits of the business carried on by all or any of them acting for all. Now, this part is most important that you need to understand in partnership. We do understand that in sole proprietorship it is very clear whatever action the owner is going to take, he is going to be responsible for it, and it is simple, nothing complicated in that. But when partnership comes, two people, or let's say two or more people, are coming together to run one organization, that is the partnership firm. So here the situation becomes a little different. It is not important who is taking the action. It could be partner A or it could be partner B. Whatever action the partner has taken, all of them are going to be responsible for it. So that is a feature of partnership, that business is carried by all of them. Either both the partner can decide that we are going to do business together, or only a partner can do the business for both of them. So anyways, the partnership functions like that. What are the features of this business organization? So it is an association. Association means people coming together to do business. There has to be two or more person for a partnership to form, and it is based on an agreement between persons. The agreement to carry on business with the object of sharing profits. And when we say profit, losses comes automatically. They have to share the profit and losses of the business. One of the most important feature is that every partner in a partnership has unlimited liability. What does this mean? Unlimited liability. So if a firm has three, let's say four partners, A, B, C, and D, each partner has 25% share in the profits and losses, right? But if the firm becomes insolvent, or when the firm closes due to any reason and they have to pay liability, let's say if the firm defaults in paying back a loan of 1 crore. So this 1 crore of loan can be obligation of the partnership itself, right? If the partnership fails, the bank can ask any of the partner to pay the complete loan, right? Even though each partner's share is only 25% in the firm, but their liability will become unlimited. It will not remain limited to the share of the partnership. We cannot say that I'm only 25% member of this firm, I can only pay 25% of this loan. Answer is no. If you are a partner in a firm, your liability is unlimited. Whatever the partnership's liability is, that is your liability. And important point, you may have to pay the liability in a partnership firm from your own personal assets also. So that is a point that is worth noting in the partnership structure. And this is the disadvantage of partnership firm, that is covered under what? That is covered under LLP or corporate structure. So are we clear that the liability of a partnership is unlimited? Then we have limited liability partnership. So what is limited liability partnership? That it removes this shortcoming of partnership agreement. So in partnership, we discussed that each partner has unlimited liability, which makes it less attractive for people, because nobody wants unlimited liability, that in case these three people do some mess up, then A will have to pay all the liability, right? So to secure themselves from this condition, limited liability partnership are formed. So what is this? LLP is a partnership in which some or all the partner have limited liability. It is a sort of company structure only that we're going to discuss, but I'm assuming that you know what a company is, right? We have limited liability in a company. So in company we have shareholders, and it is conducted by Companies Act, whereas the liability of each shareholder is limited to the share they have in the firm. This is a main feature of a company, that liability is limited to the share in ownership. This same feature is converted into a partnership where we have a agreement between, let's say, four people. They are coming together to do business, plus they have one more immunity, that their share of liability is only limited to their ownership share. So this is the advantage of LLP over normal partnership agreement, right? So let's say what we have here. It has elements of partnership, because you do not have to legally form a company, you don't have to do all these compliances, but you get the benefit of limited liability. It has an element of partnership and limited liability company. An LLP is a legal entity, and registration of an LLP is done with Ministry of Corporate Affairs. So the Ministry of Corporate Affairs is the same ministry that deals with companies, so we have to get registered under them only. Then we have another form of business, that is Hindu Undivided Family. This is a business organization that has been existing only in India, because previously in India, or still till this day, businesses are family run, right? Let's say the oldest person in the family, he started a business, then his he had two sons, they carried on the business, and further their children also came into the same business only. So they don't have a legal structure of partnership or a company, but the business is is within the company, is within the family only. That is why it is called Hindu Undivided Family Business. So it is an organization existing only in India and governed by provision of Hindu law. It is different from partnership firm, as it comes into existence not out of any contract but birth. The son has the right in the family business not because of a contract, but because he has taken birth in that family. So that is the main concept of Hindu Undivided Family. And the firm is owned by member of undivided family called co-partners. So like in partnership we have partner, in HUF we have co-partners, okay? And the main head of the family, or the senior most member, earlier it used to be male only, but now the act has been amended and they have included female member also. So the senior most male or female member of the family is going to be the manager of this organization, and under HUF or Hindu law it is called Karta of the HUF, okay? So we have Karta, and other members of the family are the co-partners, okay? For sake of income tax, HUF is considered a separate entity and taxed separately. What does it mean? The income of HUF is going to be taxed by HUF only, and the people in the family, they are going to be taxed separately. Similarly, like we have in partnership or in company. So this is HUF. Next type of organization we have, one we are most aware about, one we are most commonly dealing with, that is company. It is associations of persons. In company also people are coming together to do business, right? How they are doing business? They are contributing money. All money is worth to a common stake. They are investing in the shares of the company, and that money they invested, it is going to be used for a common purpose for which the company is incorporated. Now, features of the company are that it is a artificial person. It is treated like a person. It has a separate legal entity. It can be sued. It can hold bank accounts on its name. And this artificial person, how is it created? It is created by law. And by law, which law we are talking about? Companies Act 2013 in India, right? Under this act, all companies are formed. And this person is entirely distinct from its members. and is capable of owning, enjoying, and disposing of property in its own name. So that is the company structure. Next, we have association of persons. Now, what is association of persons? It is when people are coming together to do something on a common objective. This was what was happening in partnership, HUF company. Then why we have a separate business organization called association of person? What was the need of incorporating this? Because these people are not partners, they are not shareholders in a company, because the association is not incorporated under any of those act, but these people have come together to achieve a common objective. Now, most important thing, that member of an association of person can be natural or artificial person. They can either be individual, or companies can also be member in artificial, in association of person, and it is treated as a separate entity. Clear on that? Next, we have body of individuals. This is similar to what association of persons is. People, group of people coming together to work on a common objective, but the difference, small difference here, in association of person, we use the word person, and when we say person, it include everything. It includes in natural person and individual. It include artificial person like company or a partnership firm, but when we say body of individuals, it only means natural person. Okay. So when we are talking about a form of organization that is body of individual, it is a association of persons who are coming together to achieve a common objective, but with one condition, that all the members are going to be natural person only. Similar to association of person, this will be treated as a separate entity. Next, we have cooperative society. So, what is a cooperative society? Where individual joins hand for promotion of their common goals. So, in this also individuals are coming together and they're going to work on a common goal. But the cooperative societies are incorporated under a particular act, and that is Cooperative Societies Act. Whereas these two type of formation or agreements, they are not, they can be either incorporated or incorporate not incorporated under any law, right? But cooperative society is incorporated under Cooperative Society Act, and their main objective is that they are distinguished from the profit making aim of other form of organization. They are coming together to serve as a separate entity and to work on a common objective. For example, it could be as simple as people in a society, they formed an association that, okay, we are going to do the welfare of this society. We will take care of the repairs in our society, the festivities that we are conducting. So all those things are happening, and the objective is not to make profit, it is to run the society smoothly and have a safe and good environment around it. That it could be the objective of this organization. So it is registered in a separate legal, as a separate legal entity, and it acquires an identity quite distinct and independent of its member. It can purchase and dispose of its asset. Similar to company, cooperative society can also purchase and dispose of assets. So that was it on the type of business organization that we can see in India. So I hope we are clear on that, because once we understand the structure of business, we can understand what their financial needs are going to look like and how we are going to manage those needs. So we have next topic, it is financial decisions in a firm. Now we have the basic understanding of what businesses are there. We are going to look into what decisions they have to take, because after planning, the next step is to take decisions. So what decisions do they need to make? Let's take a look at that. Financial decision in a firm mainly relate to acquisition or utilization of capital funds. So our main purpose, financial decision are going to be related how we are going to acquire fund, how we are going to get funds in our business, and how we are going to use those funds. That is the main objective of financial decisions we need to take. So what decisions are covered under this spectrum? Number one, Estimating the capital requirement, because we need to understand how we are going to acquire the fund. For that, we need to understand how much of capital is going to be needed, and this is dependent on the organizational objective. For example, for the upcoming year, my objective is to expand in the US market. So here my capital requirement is going to be different. Or for the upcoming year, my objective is to introduce a new product in the market. Or I want to work on innovation and I'm going to develop a R&D department in my company. So my objective can be anything, and that objective is going to decide what my capital requirement is going to be. Clear on that? So the first thing is estimating the requirement. It is dependent on the market share on aimed by the organization. If I'm currently dealing in 25% of market share, if the company currently has 25% and they want to increase it to 30%, so their capital requirement has to increase. They need to invest in fixed asset, they need to raise their working capital, and this is how they're going to estimate the requirement. After we have decided how much capital is needed, the next step is to decide the capital structure or composition. Now, what is the capital structure? Capital structure is the ratio of how we are getting the funds. Any business can get capital or long-term fund in two ways. The first one is equity or owners funds, and the other one is debt, that the loans we take. So it is very important to decide for the upcoming capital need what kind of structure we are going to keep, how much owners are going to bring in, how much funds we have to get from the outside parties, right? So deciding on the capital structure. The composition of debt and equity play a very important role for profitability and sustainability of operation. How does it affect the profitability? If we have more equity, the owners will get more profit out of the business. If we have more debt, we have to pay more interest. Our credit rating is going to increase. Our working capital requirement for repaying the interest is going to increase. So, profitability gets affected by the composition. Next is deciding on sources of fund. Let's say on this part we decided I'm going to keep 25% of equity and 75% of debt. Okay. Now, from where am I going to get these funds? What part of the 75% debt is going to be working capital? What are going to be the term loan? Am I going to issue bonds in the market? How am I going to acquire these funds? That is the next decision we need to take. So, capital can be raised through equity or preference share. If you're going to raise equity, we also have option of issuing equity or preference share. Equity could be raised through right or public issue or private placement. The long-term fund can be raised through public deposit, debenture, or long-term loan from the bank. Each source of funds is going to have its own advantages and disadvantages, and it is very important to optimize the firm's weighted average cost of capital. So these are the concepts that you're going to understand in the upcoming chapters. I'm not going to elaborate on these topics here. Next decision that we need to take is how we are going to use the long-term fund. If I have taken a term loan, if I have issued bond or equity, how am I going to use the funds that are acquired? So these funds may be related to acquisition of a new asset or replacement of an old asset. So these decisions will be taken depending on the benefit of return associated with each particular project. Next decision that needs to be taken is corporate strategy or merger and acquisition. So finance department not only deals with the funds that we are going to acquire funds, they are also going to be responsible for the company's expansion. And one of the common ways of expanding is merging with other firm or acquiring other businesses so that our operations are expanding, right? So We have to focus on the growth of the organization, and growth can be organic or inorganic. Growth inorganic means we have created more assets, we are capturing more market share, whereas inorganic growth includes what we increased our market share, but not by increasing our effort on sale. We just simply acquired another business, and that business's market share became mine. So this is inorganic growth that we can have. This route of merger and acquisition for expansion has benefit of time, as creation of fresh capacity is time consuming. I'm going to go in the market trying to get new customer base, right? That is going to be uh, much work for me as compared to just simply buying another company. So this decision also depend on what level the company is financially, right? If a company is new only, they don't have much capital, they cannot think about the inorganic growth of acquiring another company. They have to take the organic path only. So this decision is also taken by financial managers. Then, use of short term funds or working capital management. We don't only have to manage the long term fund, we also have to manage the working capital. So managing our current asset and liability, receiving the ARs and making timely payments for AP, paying off loans on time, paying off interest, salaries, and everything on time. So that needs to be managed. And the major task is to trade off between profitability and liquidity, because the more a company is liquid, their profits are going to drop down, and inverse it goes. So we have to make sure that we are dealing with working capital very carefully. Another decision we need to take is the financial control, that we have to monitor all the areas all the time and see where inefficiency is, what part of the business is taking out more money than it should, and then taking corrective action to stop it. And for this, we need to analyze our financial by doing ratio analysis, costing, or budgetary control. Next important decision is related to compliance with statutory and regulatory provision related to capital market auditing and accounting and disclosure. Because if we do not comply with any of these, it can result in penalties and fine, and which will be adverse for financial management. Then once we have done the business at the end of the year, we have our final numbers, we have our profits. Now deciding how to use the profits we have earned, how much profits are to be retained and reinvested in the business, and how much of it are to be given to the investor. Because financial managers have to look both ways. On one hand, they have to focus on growing the company. For that, we are going to need as much funds as we can get. So they want to retain more, but at the same time, we want to keep our investors happy, and we have to pay them dividends also. So their needs are also being met. So it is an important decision, one of the most crucial decision that can halt the share prices also, that how much company is paying in form of dividend and how much profits it is retaining. So it is another decision that is to be taken. That was on the financial decisions. Now next step is understanding the fundamental principles of finance, some important theories, some important concepts. So first concept, and the basic and the most important concept in financial management, is time value of money. Now, how do we understand this topic? Money has time value. What we An amount of 100 today is not going to have the same value 1 year after. Why? Because let's say I have rupees 100 today, so I'm not going to keep it as 100 only. If I'm a smart person, I'm a rational person, I will invest this. And let's say in today's market, saving account or a risk-free investment is giving 10% per annum return. So if I have 100 rupees today, after a year, it is going to be 110. So the rupees 100 is not going to have the same value 1 year later as it has today, or in other words, 110 rupees a year after is equal to 100 rupees today. So the difference of 10, This is what? This is due to time value of money. The value of money is going to reduce as the time increases, right? This is rupee received today is more valuable than rupee received in future. If I'm receiving 110 today and I'm receiving 110 in future, which option do you think is more beneficial for me? If you're smart, you will select this or this. You will select taking 110 today, because if you take 110 today, you can invest it at 10%, and after a year this will be much more than 110. So that is what time value of money is. Rupee received today is more value than rupee received in future. And it is not only because of inflation, because money has earning power. We can earn money from money. That is why its value keep in decreasing if it is going to be received later in future. And this concept you will use everywhere in financial management. Time value of money, one of the most important concepts. Second is opportunity cost of money. So what is opportunity cost of money? If I have 10,000 rupees, I have many options of investing it. I can invest in option A that can give me 1000 rupees in return. I can invest in option B that will give me, let's say, 2000 in return, and I can invest in C that will give me something else. So each opportunity has something to give me in return. When I'm putting this 10,000 in this B option, what I'm doing is not only investing in B, but also letting go of this earning opportunity, right? And the opportunity that I missed because of choosing this is my opportunity cost. So when I say that I invested 10,000 in B and got 2,000 in return, in actual my profit is not 2,000. I have to let go this 1,000 of earning, and my actual profit is 1,000 only. So this is the concept of opportunity cost of money. So let's see what is given us to us here. It implies that a person deploys his money on one investment, then he must give up the opportunity to put his money on some other investment. And this concept is applied for evaluating new investment decision or retaining old asset. Because if we're I have to choose that whether I'm keeping this old asset or buying a new asset, and what I'm letting go to choose one, right? So we have to evaluate it like that. Financial decisions are not only about what I'm getting. You have to look both way, what I'm getting and what I'm sacrificing. If a sacrifice is more than what we're receiving in return, then that is not a wise investment decision, right? So that is how the decisions are taken. Then the next principle is of risk and return. Every investment is going to give us profit, and every investment is going to have its risk. We understand this from the very early days of learning business, that higher the risk we take, higher the profit we are going to earn, and lower the risk and lower the return, right? So you have to decide the balance between how much risk you're willing to take, and that is a principle of financial management. Then liquidity and return. Liquidity is going to decide that if I'm putting money in something, am I able to take it out easily, or it is blocked for a fixed period of time, and what return am I getting? Because if the investment is illiquid, let's say I invested funds in FD and I can't take it out for 5 years. So in those 5 years, if I need some amount of money, I will not be able to use the money that I already have. So while I'm investing, I need to evaluate not only return, but also how much liquid my investment is going to be, because in downtime I should be able to use my own money, right? So liquidity and return should have a proper balance. Diversification, one of the most important concept, that you cannot put all your eggs in one basket. What does this saying mean? That if that basket drops, all your eggs will be gone. But if you distribute them to different basket, then even if one of them falls, other eggs are safe. safe. So that is the same that goes for money. Don't invest in one thing only. Diversify your investment so that you can protect yourself in future. Reducing asset liability mismatch. So hedging of the risk. If we have account receivable coming to us, then we need to protect us against the losses of the or the potential liability that can be created against that. So that hedging need to be done. That is protecting ourselves from the upcoming losses. Long-term fund requirements should be met from long-term sources, and short-term fund requirements should be met from short-term sources. Then cash flow management, that balancing cash flow and inflow in proper time so that our liquidity does not get affected, because it does not matter how much your business is flourishing. If you're not able to manage liquidity, you will fail anyhow. So next part is risk return trade-off. This is we have already done. Then required rate of return. You need to understand at all time what is the minimum return that you need on your investment, and that is going to be your required return or required rate of return. And how do we calculate this required rate of return? We take, if I don't do anything or and just put my money in the safest investment option, then this is the minimum return that I'm going to get. Let's say government bonds. Plus, if I'm not putting in government option, I'm going with the riskier option, then how much premium I want for the risk taken. And I need to add this to the risk-free return, and it will be my required rate of return. So required rate of return is related to risk we are taking. So these were some of the common principle of financial management that you need to understand, and we are going to discuss these in detail in the upcoming chapters. But this was just an introduction on what the topics are. Get yourself familiar with the terminology of financial management. That was the purpose of this chapter. So let's understand the next part of this chapter, that is agency problems in FM. That what are the problems we face in financial management, and this one is specifically about the agency problem. So first of all, we will understand what agency mean and what is the agency problem. So we have heard this many times that in many of the services, the bank is acting as an agent, right? So, what does this agent mean, and what is the agency relationship? So, what is agency? It is a legal relationship where one person is appointed to perform a transaction or any particular activity on behalf of other. For example, if we have appointed, let's say this company is owned by three shareholders, a company is owned by three shareholders, and they have appointed a person, a manager, who's going to take care of all the actions of their company. So now these are the owners, these are the principal people who are going to be affected by any activity is being done, right? Because they have the ownership, they have the stake, but this is a person who is acting on their behalf. So the relationship between these two is of agency, that one person is appointed to do transaction on behalf of another. Okay, so in this we have two main parties. First is principal, the person who is appointing the other person. For example, in this case, the shareholders are principal, and the agent who is going to do the transaction on behalf of the principal, that is manager in our case. So this is what we have in agency relationship. Okay, now we have agency problem many times in financial management. How can it arise? What is this problem? So let's understand the basic aspect of how the agency relationship work. An agent is always supposed to work in the best interest of principal, as if the principal would do himself. For example, if I have hired an agent to procure material for me, okay, and if now I have now the agent has two options, either to get raw material at rupees 10 per unit, or rupees 8 per unit, and let's just assume that the quality and everything else is same, so both the materials are of same quality, same in every aspect. One is from one vendor we are getting it at 10, and from another we are getting it at 8. Now if I was the business owner and I was making this purchase for myself only, then what would I do? Like any rational person, I would buy it at 8, right? So if I am hiring somebody as my agent, I would assume that he is going to be acting in best interests just like that. He would not go ahead and buy it at 10 for his own gain. He should do what is in best interest of my business. So that is a basic expectation in any agency relationship. But agency problem arises when there is a conflict of interest inherent in relationship involving principal and agent. Now let's just say that this one vendor was giving raw material at 8 per unit, but this other vendor is giving at 10 per unit, and this vendor is my agent's relative. It is his brother's company, and he is selling the same material at 10. Now the agent has conflict of interest. On one hand, he has his brother who would expect to buy goods from his company, right? On the other hand, he has the agency relationship in which he has to act in the best interest. So if he goes with the 10 rupees option, it means he has compromised the agency relationship, and that is where the agency problem arises, when we have a conflict of interest and we are acting in our own interest instead of acting in the best interest of principal. Okay, so that is called agency problem, and it occurs when agent don't fully represent what the best interest of principal. In this case, if he was only looking for best interest of principal, he would buy it at 8 only. He would not see that this 10 rupee per unit is sold by his brother. He would go with the option that is cheaper for his company. So this happens in many cases in company, especially in financial management, because the owners of the company are different people. The shareholders are the owners, and the company is run by financial managers, right? And they are only doing a job. Now whatever the company makes, profit or loss, who is going to get affected? Shareholders. But who is taking the actions? Managers, and they have to be in the same interest. So what are the causes of this agency problem? First of all, it happens when we have separation of ownership and management, that we commonly see in most public companies, especially, right? Or a large company where there is a diverse relationship between management and ownership, and we have so many managers and the owners are different, and we have managers for each different department. So in that cases also agency problem arises. Then shareholder as owner of a company are principal, and managers are their agent, just like the example we took. And agent work for better return on owner's investment. Now, like any good agent, what is going to be his responsibility? To make sure that owner's investment is getting the best return, right? And what is owner's responsibility? That the managers should be rewarded for their actions, for the efforts they put in. But in practice, the interest of agent and owner is at conflict. The owner is trying that I may have to pay as low as possible to this agent. They try to hire people at lower salary, lower cost, and agents, what they're trying to do, they're trying to focus more on their own gains rather than increasing the return on shareholders investment, and this is how the agency problem arises in practical life. This take place when people serve their personal interest rather than honestly fulfilling their professional responsibility. So what are the type of agency problems? First, we have shareholders versus management that we just discussed. Then we have shareholders versus bondholders or other creditors. On one hand, we have owners of the company, shareholders of the company. On the other hand, we have lenders of the company who have given loans to the company, and they would expect the company to pay them more interest, so they have conflict of interest. Then majority shareholders versus minority shareholder. Now majority shareholders always want to um, do their own things, right? They would want to run the company as they like, but minority shareholders want their voice should also be heard. So there is conflict of interest in them also. Then we have stakeholders versus other shareholders versus other stakeholder in the company. A company has many stakeholder, right? So shareholders interest is only to get more return on their investment. However, the other stakeholders in the company, like employees, they would want good salary, they want good work life balance. There are investors, other investors in the company, customers, community. So everybody has different expectation than each other, and there arises agency problem. Now, how do we mitigate the agency problem? So first of all, there should be transparency in all operations. Everybody should see why the actions are being taken and what is the rationale behind those actions, right? So there is no confusion that somebody is acting for their own benefit. Next, placing restriction on capability of agent or managers. They should not be given the complete power that they can do whatever they want. They should be given some restricted powers. Like, for example, in a company, if you have to do a deal above 100 crore, let's say, then you have to take the shareholders approval, otherwise you cannot engage in such deal. So with such restrictions, we can ensure that the agency problem is at its minimum. Then, linking compensation structure of agent to the gains of principal, or providing performance based compensation structure, so that their focus is more on providing more return to investor, and uh, ultimately getting more return themselves, right? Or linking CEO compensation to the stock price performance. Principal agent relationship can be regulated by contract. There should be proper contract that defines the roles and responsibility of principals and agents, and that is how we mitigate the agency problem. So this was your topic on agency problem. Now we discussed the term conflict of interest. Now let's understand this in more detail. So we have theories of conflict of interest. One is agency theory, another is stakeholder theory. A tool to understand business challenges, especially those caused by clashing business interest. So first we have agency theory. So what does the agency theory says? It's describe the problems that occur when one party representing another in business hold a different view on key business issue. There is a conflict of interest. So agent is acting on behalf of the owner, and both of them have different view on same issue, and there will occur a conflict of interest. So what does agent have to do? They have to follow their Agents may follow their personal belief to influence key business decision, right? They will try to follow what they feel right, and they will also choose, but the agents may also choose to act in a way that is in his self-interest, gets preference instead of the principal. And agency theory mainly focuses on interest of the shareholder. So this is the one where we're talking that talking about from the point of view of shareholders, that agents are acting in their own principal interest. Their business decisions are influenced by their own personal biases, and they may not act in the best interest of shareholders. So this problem is from the point of view of shareholders, where agents are not acting properly. Now we have stakeholder theory. So in stakeholder theory, uh, we highlight the difference of interest between individual groups within an organization, such as employee interest and supplier, as also outside stakeholder like the local community. So the difference in expectations of these particular groups against the expectation of the shareholder of the company. Shareholders are concerned with the return on their investment, but there are other stakeholders in the company also who have different expectations. Like we discussed, that employees want better work life balance, investors want better return, suppliers want they be paid on time, right? And the local community want that the company who is making profits from them should also give something to them in return. So they have different interests. And the stakeholder theory describe composition of organization as collection of various individual group, and it include interest of all stakeholder of the organization. So if we take care of the all the interest of stakeholders, so what happens, we have a big conflict of interest. If we are let's say if we are going to take an expansion project, let's understand with example. We have an expansion project on which we need 100 crore investment. So let's understand how the interest of different parties are going to get affected here. On this project, the employees may have to work overtime. Let's say 2 hours a day, they will have to work overtime. So employees' interests are getting affected. They would not want that they have to work overtime for every day for a year, right? So it would be like this decision is against their interest, whereas this expansion can lead to huge growth for the company. Even though the company is growing, but employees are feeling that their interests are not being taken care of, right? And from this expansion project, the community may have a problem that the land you're building this factory on, and you're using the community land and you're polluting it, and they would not want that the company build this lands, right? So again, there is conflict of interest in society versus the company. Then we have investors. Now we need 100 crore investment for the growth of the company, and investors do not want to put in this much of money. They want less investment and more return. So you see, every stakeholder has a conflict with this, but the ultimately benefit is to the company is growing, but each stakeholder is feeling that their interests are not taken care of. So that is the conflict of interest theory from the stakeholder aspect. So this was your topic on conflict of interest. We have next topic, that is on business ethics and social responsibility. So what are ethics normally? That are moral judgment, rational justification for our moral judgments, and it defines like this is right to do and this is wrong to do. Like for example, if we know that somebody somebody is not physically capable of moving upstairs, and we are not providing them proper stairways, right, for handicapped people, and we are doing ethically wrong, right? So these are the example of ethics. Now what are business ethics? How does right and wrong gets defined in business? So business ethics focus on what is right for shareholder and stakeholder. If what you're doing is in interest of shareholders and other stakeholder of the business, that means you're following the business ethics. And if you are doing something that is against their interest, it means you're breaking the business ethics, right? So business ethics drive the code of conduct of a company, and they have well documented code of each company has well documented code of conduct applicable. Now what is its importance for stakeholders? Why are business ethics important? So from stakeholders point of view, when we say that the company is following business ethics, when their interests are taken care of, and it is very important for the success of the company. Now, from employees' point of view, if they think that the company follows good ethics, from employee point of view, it would mean that they are providing them good work-life balance, they are providing them good compensation, right? What will be its result? The company will be able to attract best talent in the industry, and they companies which take care of their employee and apply high ethical standard in dealing with them. You don't fire employee in like in a wrongful manner. You do not do wrongful terminations. Then you get high productivity from employee and lower attrition rate, that employee would retain for a longer time. And the customer, so in any company where the customer think that the business is treating them ethically, they are providing them quality service or quality product, then they become repeat customer, and build an ongoing relationship. So in that way, whenever the company is following business ethic with different stakeholders, they get good returns. So that's why it is important to have a written policy on code of conduct that all managers and the people within the company need to follow, Now, let us understand what are some principal code of conduct that need to be followed. So first one is honesty, that you don't under measure the impact you're creating on the environment, or don't over invoice, don't push substandardized product as a high quality product. So be honest with whatever you're offering. Then integrity means you don't go ahead and follow the way that makes you quick money. You be principled, follow the principles, and do the business in a rightful manner. The company should be trustworthy. For example, if they are saying that we will provide you this particular service of this quality, then the customer should believe that this will be provided. That trust should be built between company and the stakeholders, right? So keeping the promise, that's how you build trust. Next, loyalty to expect its employees to be loyal to the company, but companies may also integrate this principle into their code of ethic with an intention of being loyal to their employees and customers. So it goes both ways, right? You expect that your customers and employees be loyal to you, then you also have to be loyal to your customer and employees. You also have to act in their best interest. Only then they are going to act in your best interest. Then fairness, being fair in your dealing, just to make unfair advantage or take unfair gain on one transaction, you don't lead to loss of others, right? You don't play on such situation. And having empathy, understand others feeling, right, about employees, customer, and society. If their society's interest is getting affected, you take proper action to take care of that. Then we have another principle that is on respect, that treat everyone with the respect and dignity, your employees, your professional customers. Next is compliance, that wherever the company is operating, on whichever country the company is operating, you have to follow their rules and regulations properly. You don't play with the rules and regulation. You don't find loopholes to make advantage, right? For example, an ethical company would avoid making unscrupulous advantages adjustment in sale to reduce its GST liability. You don't do unfair dealings just to bypass the legal requirement. Next principle that companies are expected to follow is pursuit of excellence, that you're committed to excellence in whatever you do, add value in the product or service, not simply focus on the profit. Leadership, any ethical business or any ethical management will strive to make a positive impact on other, to be a positive role model for other, to create environment for growth and principle reasoning. Then reputation, so company want their employee to conduct in a manner that builds and protect their reputation. Responsibility, taking responsibility toward employees, customer, partners, and society. Then the company also has social responsibility, that it has to maximize the shareholders value by acting in a manner that is beneficial to the society, and to adopt policy that promote the well-being of society. So some example of company fulfilling social responsibility, like arranging blood donation camp, cataract surgery camp, medical checkup camp, advocating implementing child labor laws, collection or recycling of plastic waste. These are some example through which a company is fulfilling its social responsibility. And a big example of that compliance part on that is corporate social responsibility, that is mandatory legal requirement for companies to follow under the Companies Act. So in India, in the Companies Act, if a company's profit increases a certain amount, then they have to spend at least 2% of their average net profit made during the previous 3 financial years toward corporate social responsibility in the current year. So in this way, the law is ensuring that company is giving back to the society as well. They are making it mandatory for the company. The company must disclose the detail of CSR activity separately in the annual report, and the statutory obligations are laid down in Section 135 of the Companies Act. So that was the topic on ethical practices and example of good ethics. Now, the next topic we have relationship of finance, the finance department that we are going to see, to economics and accounting. So, how does the relationship between these three principles work? First of all, economics and finance are interrelated disciplines. Finance is a discipline which is basically derived from economics, and it involves assessing money, banking, credit, investment. So it is derived from economics only. Economics, what does it what does economic do? So uh, taking understanding how the goods and services are made, distributed, and used, how the overall society is perceiving any particular commodity, what is the consumption pattern, or how will the demand arise. So all these things we study in economics, and from these principles we study finance, where we see how we can make more money, where should we invest on the principles of economics. So this is how finance and economics are interrelated. How are finance and accounting interrelated? In accounting, we are focusing on day-to-day management of financial report and making sure the records are up to date in the business. Then, the information that is recorded by the accounting department is used by finance to project the future growth, to see where we can expand more, to see where we can invest more, and that is how accounting and finance are related. Now, then the next topic is emerging role of financial managers in India, finance managers in India. So they have to deal with how the money is raised from investors, how that money is invested, and what returns the investors are getting on their investment. Key areas related to role of financial finance managers in India. First of all, they are involved in selection of projects. Relaxation in industrial licensing has resulted in increased competition, which has made selection of a project more challenging. You have to make sure that you select such project in which you know you can perform better, you know you can get more returns. And since the competition in market in almost every area is really high, it is very important to choose the right project, and that is where finance managers do the research and analysis and find out the project. Then raising equity. Once you have decided the project on which you want to work, it is important how you're going to get the money, the capital required to work on that project. And abolition of capital issues act has helped expansion of capital market and made it easier for company to raise resources. You can easily raise money by doing public issue. Then if we are taking debt, then you have to see that what interest rate we are going to take, right? With deregulation of interest rate, the stability of market rate of interest has reduced. Previously, the interest rates were regulated, but now the stability has reduced because they are not regulated anymore. So whenever you're working on a project, you have to choose whether you're going to take fixed interest rate or floating interest rate, and these factors also need to be considered. And then we have interest rate derivatives, like interest rate swaps are available to hedge the interest rate market, and these choices will be made by the manager, that how we are going to deal with our interest rate risk. Foreign exchange management, if we are dealing globally, then we have foreign exchange risk. We have to hedge that risk properly, and we have to make sure that we are following the regulations created by FAMA Act. So it is the role of finance manager to see the risk we are taking, to see the foreign currency exposure we have to take, and to take proper exposure and proper hedging to reduce that risk. Treasury operations are also conducted by financial managers. So many firms derive substantial income from their treasury operation, like growth of mutual fund, emergence of highly innovative financial instrument, and financial managers now need to also focus on how they are going to invest in the short term market, right? So treasury operations are like, if you have cash laying around in the company, rather than keeping it in the bank, you can invest that in liquid fund like mutual fund short term, so that you can get return. and coping with the technological changes or data availability. So, like we're seeing that these days artificial intelligence is increasing, and finance manager also need to focus on the innovation, that our operations are up to date with the market, our technology is up to date. And dealing with rating agency, while we are conducting our business, we are raising fund from debt market and equity market. It is very important that our credit rating is maintained properly, because credit rating will affect the reputation of company, and at last finance managers are expected to report to the investor any important information as soon as possible. So this was your chapter number 1 on financial management, or chapter 19 on the module C. Okay, so I hope you were able to understand it in a good way, and if you like the video, then make sure to like the video and subscribe to the channel and let us know how you like the video. So thank you so much for your time. I will see you in other lectures. Bye bye.